Good morning, everyone. Welcome to our November CGBN Commercial Global Business Network webinar. I hope you're all doing fantastic today. Before we begin, many of the persons listening and are watching this webinar may be direct competitors in the real estate brokerage business. Therefore, to avoid any liability under the federal or state antitrust laws, any discussion of the competitive business practices and/or the amount or fees and/or commissions charged or to be charged by the real estate brokerage companies charged by real estate brokerage companies to their customers or clients and/or compensations and/or splits paid or to be paid by brokerage companies to other brokerage companies is strictly prohibited. It is NICAR's policy that it will not entertain any discussion that creates the potential of a violation of federal or state antitrust laws at any meeting, podcast, or conference sanctioned or sponsored by NICAR. Please note that this session is being recorded. To ensure a smooth experience, we kindly ask anyone who is not presenting or part of the panel to mute themselves and turn off their video recording. Our session today will run for an hour and a half. We'll start with presentation, followed by the Q&A segment for the presenter. Once the Q&A concludes, we will end the recording and transition into the needs and wants segment done by Teresa Mueller. If you have a listing or trade mission to share, please let us know and we'll be happy to feature them on the CGBN page. After today's session, the recording will be available on the CGBN YouTube channel and the CGBN page. In the meantime, please take a moment to share your information in the chat, including your name, email, and phone number, and any needs and wants you'd like to address. For those of you who may not know me, my name is Dimitri Lachman, and I'm the current chair of CGBN, as well as the president of NICAR. Marsha Collins is the vice chair and will be taking over in December. I'd like to take this opportunity to express my sincere gratitude to our past CGBN chairs, Ahmed Badat, Teresa Mueller, and Bill Caden, for their invaluable contributions and continued support. I will let Ahmed say a few words before we get started.
Thank you, Dimitri. So I don't know where Bill is, but I was hoping he was available. I'm sure he's got tied up with something. But Bill Caden, I got to mention his name. He founded this, and from day one, we've been running with this program with our monthly webinars and events. And then it turned into, well, we were having live events until we had COVID-19, and then it turned into monthly webinars, starting with our first presentation at the NICAR virtual conference, where we had a round table. Teresa's familiar with that. And so so it's been a very successful event. Thank you, everyone. Yeah, I recognize a lot of the faces. Mr. McCord, my old friend, I see Ellen Huxtable, who was one of our strong supporters in the early days with Bill Price. So I caught up with her yesterday and had a good chat. And I'm glad to see her here. And there's a lot of other people. And thank you to Tim. I mean, he has a very busy practice with one of the largest law firms in the country. And so I'd like to thank my friend Tom Fryer to making the connections. And thank you, Tim, for being available to us today. And we are looking forward to your presentation. Thank you very much.
Perfect. Well, thank you, everyone, for joining us today. Today's webinar is called Impact on Tariffs and Trade on International Investment in the U.S. Today, we're honored to welcome Timothy J. Keeler, a distinguished leader in the global trade, cross-border investment, and national security review. Tim is a partner at Mayer Brown, where he advises major international companies on some of the most complex issues involving global transactions, and Committee on Foreign Investment in the United States, CFIUS, and the U.S. National Security process that evaluates foreign investment. Legal 500 and Chambers describe him as someone who, with a deep understanding of how the administration and Capitol Hill work together to shape U.S. trade policy, and note that he has remarkable instincts for how CFIUS will handle sensitive and high-stake deals. Before joining Mayer Brown, Tim built an extraordinary career across multiple branches of the U.S. government. He served as Chief of Staff to the U.S. Trade Representative, where he oversaw U.S. policy and negotiations on everything from US China relations and World Trade Organization litigation to free trade agreements and major international investment issues. Prior to that, he held senior roles at the US Treasury Department, which chairs CFIUS, and worked on the Senate Finance Committee, focusing on international trade policy and export controls. Across all of these roles, he has been at the center of decisions that shape global markets, trade flows, and international investment strategies. Today, Tim brings that expertise to help clients navigate global deals, mitigate national security concerns, and anticipate the policy shifts that affect the global business landscape. We're incredibly fortunate to have him with us today, and we're excited to learn from his perspective on where global policy is headed and how it impacts international business and investment. Tim, all you.
Thank you, Ahmed. Thank you, Teresa. Thank you, Dimitri. That was a very kind introduction. I might have to bring you on the road with me, Dimitri. That was very too kind. So great to be with you all today. Thank you so much. As mentioned, I'm going to be talking about tariffs, trade policy, U.S. investment policy at the federal government level. We'll save time for questions at the end, but if there's a particular topic that you would like what I'm talking about and you want to ask a question, I welcome it. And, whatever the normal process is for asking questions, please utilize. So, this year has been a wild ride, to say the least, when it comes to tariffs and trade. This is when I first started working on international trade 25 years ago. This was like, when I go home, this was not a topic I would get asked about, or would people, like, if they'd humor me if they asked me about it, right? It wasn't people actually asking me about it. And now, especially with, the near debacle of Liberation Day in April, it's of high interest no matter what sector you're working in, because it's been such a presidential priority now for 8 or 9 years. So I'm going to start with talking about how did we get where we are today in 2025, especially from President Trump's first term, which actually did look remarkably different in retrospect to where things have been through not even the first year of his second term. President Trump came into office in 2017, having talked more about trade than any presidential candidate in a long, long time, probably 100 years almost. But in comparison, what he did in his first term was much more limited and focused in the trade front. So in his first term, he imposed, and it wasn't until after a year into office, because they jumped through a lot of investigations and legal procedural hoops first, but he applied tariffs on steel, and these were national security-based tariffs on steel imports and aluminum imports. So those were product-specific, fairly narrowly defined, and fairly focused. He also imposed tariffs on China, starting in 2018, but those were not consumer-facing, and they were phased in over really the next 2 years, 2018 and through 2019. So much more limited. At the time, it was such a revolutionary change. It didn't feel like it was very limited, but in retrospect, it sounds almost quaint to what we've seen this year so far. At the same time, you had the Trump first-term tax cuts enacted at the end of 2017, so really the start of 2018. So you had, if you look at this as fiscal policy across the board, you had domestic tax cuts, and you had fairly narrowly scoped tariffs that occurred as I described. He also renegotiated what had been the North America Free Trade Agreement, NAFTA, and during the first term renegotiated that into the USMCA. While there were major changes made in that agreement, there ended up not being, the U.S. didn't leave NAFTA, so it wasn't the kind of abrupt new tariffs. There was a threat of that, and that garnered a lot of headlines frequently, but that they were successfully renegotiated NAFTA into USMCA, and the Congress approved that in late 2019, early 2020, just before COVID hit. Also, just before COVID hit, US-China reached an agreement called the Phase 1 Agreement, which, while that did not get rid of the tariffs on imports from China, it lowered some of them. And even then, the tariffs were only hitting about 50% of all imports from China, and they ranged from levels of 7.5% to 25%, none of which was effectively prohibitive, as in the imports kept coming, although it did change the composition over time of what imports happened. I give you that background just to say, well, how does that explain how we got where we are in 2025? Well, obviously COVID hit in 2020. All these things kind of went to the back burner. President lost re-election. President comes back, thinking about trade policy a lot of times over this time period, and has formed definite views about what he would like to do differently and what he'd like to do right away when he came into office. So, and his other big takeaway, I think, was a lot of people, a lot of very prominent people, a lot of economists told him that if he applied tariffs on anything or any country, the sky was going to fall. And I think his takeaway coming into his second term was, I was right, everybody was wrong. I applied tariffs. Not only did the sky not fall, pre-COVID, generally accepted that the economy was very strong. So and his takeaway, I think, was, I can do whatever I want, and there's really not going to be, it's going to be no downside. So he, I think, overlearned the lesson of his first term, and he came in and using what's called the International Emergency Economic Powers Act, or IEPA, which in fact had never been used for tariffs before, but came in and on April 2nd announced Liberation Day, where every country in the world got a minimum baseline tariff of 10%. And then on top of that, a variable tariff depending on a number of factors, most likely something that's connected to the bilateral trade deficit with that country. And, this certainly, at least for 150 years, trade policy hadn't been done this way. And I think it's fair to say it had never been done in a way where, in response to a bilateral trade deficit, the tariff levels were being imposed as a response to that. Before I talk about what the market reaction was, I'll talk a little bit about what else he did. He did also impose tariffs on automobiles imports and auto parts. This was leftover national security investigation that he initiated in his first term, and it sat dormant until he came in. So he had sort of the loaded gun, was able to pick it up on that. So now these IEPA tariffs were a country by country basis, as I mentioned. They've also launched a series of product specific tariff investigations. This is similar to steel and aluminum investigations for the first term, but in addition to autos, auto parts, copper, pharmaceuticals, semiconductors, medical devices, drones. There's a whole series of these product specific investigations that are currently ongoing. Copper is the only one, in addition to the three I mentioned earlier, that has come to fruition, and they've imposed tariffs on some downstream copper imports. So April 2nd comes, President announces Liberation Day, imposes massive tariffs on every country in the world. The markets revolted, both the stock, the equity, and the debt markets. And within a week, the president had to backtrack. This was something consistent with his first term, although the tariffs were much more limited. There was one time when he proposed raising tariffs to a much higher degree on China. The markets reacted negatively, and he did back off. So it's fair to say the biggest check so far in this space on the president's authority has been essentially what the markets can withstand. I apologize. I'm in Washington, D.C., so you might hear a police car going on in the background. That's a fairly regular occurrence. We call that, every day. The president backed off. He effectively changed who his leading advisors were. Prior to that had been Secretary of Commerce Lutnick and Pierre Navarro in the White House. And after that, the Treasury Secretary Scott Bessent and the U.S. Trade Representative Jameson Greer became the leading voices and his representatives on these issues. They dialed back all those tariffs, the Liberation Day tariffs, down to 10%. And instead essentially said, we're going to negotiate with all takers. Over this summer, the negotiations weren't moving as quickly as the president wanted. And so he started essentially sending private letters saying, if you don't give us what we want, we're going to move to new tariffs. This is generally around August 1st or September 1st. And countries did start moving in response to that. The United Kingdom was the first one out of the gate to reach an agreement with the United States. Because of that, they've gotten the most favorable deal, and there's been deals struck, as I'm sure you've seen in the headlines, across the board. President also, I'll walk through sort of what's the way to group these countries. The close allies, close defense allies, effectively have gotten the best treatment. UK, Canada, Australia, New Zealand, all around 10% a little higher. He gets into tiffs with Canada, and we'll put that in a separate category for the moment. Canada and Mexico will put in a separate box for a moment, but that's sort of on the Liberation Day tariffs who's gotten the best deal. The next up would be, again, close allies who've negotiated. European Union, which does it for trade purposes, negotiates as a whole. France and Germany don't negotiate individually, and they're about 15% tariffs all in, not only Liberation Day tariffs, but any of these product specific tariffs I've mentioned. It's capped at 15%. Japan is in a similar position. I think South Korea is also in a similar position. The next grouping, I would say, is Southeast Asia countries. I think you can put them in a box of risk of a transshipment hub from China. And I use the phrase transshipment loosely. As a legal matter, transshipment usually means fraud, where you might bring a product in and stamp it as being from Vietnam when it's not really. In this context, it's more about the risk of low-priced Chinese inputs going into those countries, being made into a different new product or some downstream product. It might technically, under customs law, be considered a product of Vietnam and not China, but that's a pressure point that they want to put on Chinese exports. So Southeast Asia countries are generally higher, between 20 and 30%. And then China is obviously its own separate category. The president did impose, because of Chinese retaliation this summer, prohibitive levels of tariffs on China, upwards of 150, 175% when you add them all together. That was going to lead to empty shelves, and so that wasn't an equity or credit market issue. It was literally the big box retailers going to the president saying, you're going to have empty shelves, which would have been, obviously, after these recent years of inflation, a supply crunch would have been very politically devastating. So the Chinese had some leverage from that. The Chinese also had some leverage because they have not only threatened but restricted the export of processed rare earths and critical minerals, which they have a supermajority of the refining and processing capacity in the world. The U.S. can't make cars and can't make a lot of other products without these refined and processed rare earths and critical minerals. So that's an area where the administration has been trying to to invest in U.S. companies and build up capacity to conduct that refining and processing, because although it's described as rare earths, we actually do have the mining capabilities on it, but we don't have the processing or refining capabilities. So that's given the Chinese the ability to negotiate in a near equal status with the U.S. Those negotiations have been fairly rocky, as I'm sure many of you have seen. They're in a bit of a détente at the moment, having reached another year pause on some of the back and forth retaliatory actions between the two countries, with the U.S. Pausing some of its tariff threats, also pausing some of its export control and sanction that they're going to impose on Chinese and subsidiaries of Chinese companies. The Chinese have agreed to start buying soybeans again, and have agreed to pause the restrictions on exports of, as I mentioned, the rare earth and critical minerals. It's very tenuous and can certainly blow up at any time, but the two presidents met, President Xi and President Trump, and for now that seems to be proceeding. With Canada and Mexico, there is a previously scheduled renegotiation that will happen with the U.S. MCA. When the president came in, he imposed another set of tariffs that I haven't mentioned yet. These are to combat fentanyl imports, and tariffs were imposed on Canada, Mexico, and China on that basis. That's essentially been treated separate and apart from all the other tariffs that I've mentioned. And that has been a central part of the U.S.-China negotiations, where China has agreed to stop the export of some of the precursor materials for fentanyl, and the U.S. has been heavily pressuring Canada and Mexico to stop production of or shipment of fentanyl as well. So it's been, to say the least, a eventful 2025 in this space. The other big factor that's been happening has been litigation. Certain importers and small businesses challenged the tariffs that were done on the basis of the International Emergency Economic Powers Act, as I mentioned, IEEPA. And you may have seen that the Trump administration lost in the lower courts, both the Court of International Trade, which sits in New York, and then the appeals court level is the CAFC, the Court of Appeals for what's called the Federal Circuit, which also is a specialized court for, among other things, international trade and intellectual property. As I mentioned, IEEPA has never been used for tariffs before. It is not an easy case, because a predecessor statute called the Trading with the Enemies Act was the basis for which a similar action by President Nixon, where he imposed 10% across the board tariffs in the early 1970s as part of going off the gold standard and other trade negotiations, and those tariffs were ultimately upheld. That language from Trading with the Enemies Act was carried into IEEPA when IEEPA replaced Trading with the Enemies Act for non-wartime emergencies. The Supreme Court actually heard arguments on whether this was legal by the president, I think 2 or 3 weeks ago. It's very much up in the air whether the court will uphold the president's actions. It's, as I said, it's unprecedented. It's a case of first impression. It's definitely possible that a majority of the court will hold the president does not have this power granted by Congress, or if he did, it was unconstitutional delegation of authority. And if I had to guess, I think he's probably going to lose based on the tenor of the questions and I think the discomfort many justices had with the idea the president can just rewrite the harmonized tariff code every single day. But it is, I think, a much more difficult legal question than people assume at first glance. If he loses, that's also going to be a very big change. The court will have to lay out, well, what happens next? Are refunds going to be available? I think if he loses, then refunds are likely to be available. They've collected at least $100 billion through these tariffs. By the time of a decision, it could be $200 billion. So these are big amounts of money. They're paid by importer of record as a legal matter, but contractually, transaction by transaction, parties can agree who's going to bear the economic incidence of the tariff. It won't be something that gets back to consumers to the extent some of these costs were fed into downstream consumer prices. How the markets are going to react to that is also unclear. You would think the equity markets would like that kind of fiscal injection. On the other hand, even for the federal government, $200 billion is a material amount of money. And, the budget deficit, while a little bit smaller this year for fiscal year 2025 than it was the prior year, there is some concern about how the credit markets would react if suddenly these refunds have to be paid and the government has to borrow money to make these refunds. So that's I think something to keep an eye on. Now, that all being said, just because the president might be found to not have this power through IEEPA, they do have a backup plan, and the backup plan is essentially to get whatever tariff rates they are today, to get there in about 5 or 6 months. I should note, I've talked about a lot of different tariff authorities. They have not tried to cross over these tariff authorities. So in general, let's say a product is subject to a 232 national security tariff, like that which is applied to steel, aluminum, or autos. In general, they've said if you're subject to that tariff, that product is not also subject to the IEEPA country-based tariff. They've tried to not stack these as a general matter. So this ruling could make some tariffs fall away, but not the product-specific ones. Those have not been affected this whole time. Their backup plan is to take essentially a statute that Congress passed in the 1970s that gives the president authority, if there's a balance of payments issue, to impose tariffs up to 15% for about 5 months. And then I think they're likely to also launch a series of country-specific investigations under what's called Section 301. This is the authority the president used in his first term to impose tariffs on China and recreate where all the Liberation Day tariffs and agreements, but have to go through some an investigative process and jump through some legal hoops to get there. And so while there might be some beneficiaries to refunds, there might be some short-term beneficiary countries where, let's say today, they're facing a 25% IEEPA tariff. They'll have a period of time where that goes down to 15%. Eventually, they'll be able to likely get back to where they are today, just using different authorities and having different legal hoops to jump through. So there's just been a lot of authority delegated to the president in this area for many, many decades, and for the most part, a lot of these authorities had not been used. Lastly, before we open it up for questions, let me talk about what the president and his administration has done with respect to investment policy, both inbound investment to the U.S. and outbound investment. As background, there is an existing function for the U.S. government to protect national security that might be threatened by certain foreign investments into the U.S. It is a committee of the executive branch called Committee on Foreign Investment in the United States, or CFIUS. It's chaired by the Treasury Department, and CFIUS, as I mentioned, has the authority to investigate foreign investments into the U.S., and the ability to pause such investments, the ability to impose conditions on such investments to address and mitigate any national security risks. And the president has the authority to actually block such investments or unwind them, force a divestment if a transaction has already closed. Occasionally, you see it get in the news. This authority was very much in the news for the U.S. Steel, Nippon Steel transaction. President Biden actually used his authority to block that transaction. President Trump ultimately reversed that decision and permitted the transaction to go through, but with conditions such as a golden share for the president to veto any certain decisions. The president issued a memo after he came into office called the America First Investment Policy. This had a lot of ideas that, frankly, some of in the details many of them were kind of unworkable, and I think they've realized that since. What's notable about the America First Investment Policy, and what we've seen as we've handled cases for clients, is that the big picture rhetoric seems to be applied. That rhetoric was that they want to be very friendly to investments from allied countries, Canada, UK, Western Europe, Australia, Japan, New Zealand, South Korea. They want to be very favorable to it, and I think they have. We are seeing anecdotally on a case-by-case basis, because most of this is done confidentially unless large companies have public reporting requirements. They do seem to be approving allied country investments more quickly and with less conditions, and I think that seems to be a notable change. The other piece of rhetoric, not surprising, is that they want to be tougher on investments from adversary countries, notably China. And the America First Investment Policy sounded very hostile to active investments from such countries. It said passive investments would be okay. There hasn't been a lot of Chinese investment as a result, so we don't have as much anecdotal investment, either from what I hear others in the CFIUS bar or ourselves. I think by the end of the year, we might have a bit more data points to look at. It doesn't look like this was something that was really agreed to or addressed in these U.S.-China agreements, and that doesn't surprise me. But to return to the U.S. Steel, Nippon Steel deal, I think that's another example of an allied country investment that was treated, ultimately approved, in a more friendly fashion than had been the case under the Biden administration. Now that deal was very unique in that it was involving an iconic American company in U.S. Steel, headquartered with a lot of jobs in a swing state, Pennsylvania, during an election year. That's an unusual fact pattern, and I think it's not really news to say, those political wins and promises made by President Biden during the campaign, and also, frankly, threatened by President Trump during the campaign, drove President Biden to try to veto that investment. The parties sued, tied it up in court for a little bit, long enough to allow President Trump to come into office, and ultimately reverse President Biden's decision and allowed the deal to go through with conditions, particularly to increase the amount of investment that new investment in Nippon Steel was committed to do. Finally, at the end of the Biden administration, a new policy went into effect that starts to regulate outbound investments by U.S. persons. The Trump administration has supported this policy. This is effectively regulating investments by U.S. persons into Chinese connected companies. Now, I say Chinese connected because it's not limited to investments within geographic scope of China. It could be subsidiaries of Chinese companies wherever they are located, including in the United States, or parents of Chinese companies if they're particularly dependent by certain metrics, like more than 50% of their revenues or profits are derived from a Chinese located subsidiary. And so the scope of that jurisdiction is, very broad in both directions, up and down the parental chain. The limiting factor is it's focused on three sectors of the economy: semiconductors, quantum computing, and artificial intelligence. Artificial intelligence is obviously the area that could be the broadest. I think if you're investing in semiconductor companies or quantum, you're going to know you're doing so. It'll be pretty easy to figure that out. And whether you're subject to either a prohibition or a notification requirement to the US Treasury. AI, of course, is apparently becoming more ubiquitous every day. And so it's AI. What it regulates is AI for certain uses, such as robotics and a number of other uses, or at certain computing powers. Not a tech person. I assume that these computing powers are going to be making leaps and bounds every year. So the breadth of this, scope of this rule, and the use of AI, or that robotics developed on AI, could be expanding every year. And the Trump administration has certainly supported this policy as well. So I've been talking quite a bit. I'm going to wrap it up there, and I welcome any questions you all may have.
Dr. Mustafa?
Yeah, I have a question. First of all, is the tariffs considered to be a tax? And if it is a tax from an accounting standpoint, does that money go into the general revenue fund, or is it directed to any other particular fund?
It's a great question. Let me answer the second part first. It goes in the general revenue of the Treasury. The president recently has been talking about using that money to issue $2,000 checks to people. They're going to need an act of Congress to spend those revenues. I'm confident they spent a lot of time trying to figure out, is there any way we have the authority to just cut these checks on our own to make the tariffs more popular? And the Treasury Secretary came out recently and said that would take an act of Congress. On the are tariffs a tax question, I think in the colloquial sense, yes. One of the, as a legal matter, one of the arguments the administration made to the Supreme Court was that, in fact, the tariffs they imposed are not a tax, that their purpose was not actually to raise revenue. The purpose were these other economic goals, and that if they were therefore regulatory tariffs based on the power in the Constitution granted to the Congress to regulate foreign commerce, and that if their economic goals are successful, then the tariffs won't actually collect any money. But
if it's a regulation, isn't that considered a tax? Anything that is revenue generated from a regulation?
Right. So their argument, just giving you their argument, is that any money that is collected as a result of a regulatory tariff is incidental, and it's not based on the power to tax, but the power to regulate. As a practical matter, I'm not sure it really matters, because if you got to cut a check to the Treasury Department, you got to cut a check to the Treasury Department, and it feels like a tax. If you're the importer of record, or you're the person who's contractually bound to pay the tariff, But just so I just want to let you have that background on this is an issue that the Supreme Court's gonna have to rule on. So
Thank you.
yeah.
Teresa, Ahmed, and then Marsha.
Okay, thank you very much, Tim. Really great content, and I love this kind of stuff in summarizing what happened. And I have half a dozen questions. I'll ask my most important one, and then I'll put myself at the back of the queue so others have questions. But probably the most important question and relevant for this particular group is what you think are the risks and the opportunities for commercial real estate practitioners here in the U.S.
Well,
did you want an easier question?
well, it's I'm trying to think like how does you all probably have a better sense of how what I've discussed, how it hits your business specifically. I suppose, foreign investment in the real estate space has been a big issue in that could be a risk. I think I've talked about CFIUS. Let me expand on my CFIUS discussion a little bit. As a general proposition, CFIUS's authority to review foreign investment only applies to investments in existing U.S. business, not greenfield investments, i.e., not acquisitions of real estate, unless the real estate is near ports or certain military installations. However, there are a lot of state level measures that are restricting foreign investors, particularly from China, into real estate of any kind. They're popping up all over. They're being challenged in courts, but and my general hunch is eventually, if somebody has successfully gets standing, some of these state level measures will be struck down. But I know sometimes there's Chinese investors indirectly investing in commercial real estate, and Florida, for example, has prohibited even indirect investments by Chinese investors. So Texas has some similar restrictions. So that's certainly one thing that comes to mind, and unclear exactly how that all plays out. And then secondly, obviously, if there's any actions by the president that create some of these big market impacts, that affects every sector, including, I would assume, in the commercial real estate sector. So, but welcome if there's a particular thing I talked about that you all are interested in, that you think it hits your sector more. So happy to expand on that.
Thank you.
Ahmed?
Yeah, thank you, Tim. Great information. So since every morning there's a backflip with tariffs, and we refer to the administration. It's really a one-man show, and everything is transactional. So we're just receiving the crown prince from Saudi Arabia. So the backdrop to all of these things happening is family.
That has to do with our job. Can you explain yourself? Put your politics aside. Let's not take in politics. Let's talk what is most interesting. I don't care about what politics of.
No, it's not politics. Can you just mute yourself, please?
I will.
Oh, the question here is, Illinois being the largest soybean producer, we find ourselves, the farmers find themselves hit very hard by the tariffs. And I think it's got a long-term effect, not just affecting the farmers, but also the state of Illinois. Similarly, we've had the same effect with the with the importation of beef from Argentina. So how do we reconcile these two things going on?
Sure. And one thing I want to, in addition to answering that question, I think I'll mention some of the investment portion of the deals that have been reached with various countries. I think that could be of interest to you. Soybeans get a lot of attention in Washington, D.C. There's no doubt about it, because the Chinese market had been so big and they effectively shut it off. As I mentioned, the Chinese did agree to start buying U.S. soybeans again. Whether they're following through on that is not as clear. I think soybeans are more, anytime there's a deal or a détente between the U.S. and China, it's going to be good for soybean farmers in the U.S. I don't know that the soybean farmers are going to be the real leverage for the Chinese. Ultimately, it's more on the rare earth things, exports, because that has the ability to really cripple large parts of the U.S. economy. And at the end of the day, while important to Illinois, soybean production is it's not nearly the level of impact. And also, a lot of those farmers do have the ability to plant other crops. The beef from Argentina thing has been interesting, because for people who have been following, President has a very good relationship with the president of Argentina, and Argentina has had its own balance of payments issues, where that president has, I think, largely defeated inflation and taken pretty dramatic reforms to get out of a large budget deficit, but he's got a massive foreign exchange problem. And so the U.S. has, prior to their elections, had been bailing out, might be too strong, but essentially saying we're willing to bail out the Argentina's foreign exchange problems. I think also price of beef have been rising in the U.S. President agreed to take in more Argentine beef imports, which both helps the Argentine government on its foreign exchange problem. Has possibility of lowering beef prices in the U.S., but that created obviously a different domestic political problem for the president with cattle ranchers. And the net result, I think, is the Department of Justice has now opened an investigation of the meat packing and meat processing industry for antitrust purposes. So you're right. The president is definitely, he approaches each country in a transactional fashion, and wants to reward allies of the U.S. and put pressure on opponents. So I will also note, in a lot of these agreements that the U.S. has reached with each country, there's a dollar amount about how much that country will invest in the U.S. It's not a lot of clarity so far on what does that mean. How is the foreign government going to guarantee that there's $350 billion worth of private investment? It's very unclear exactly how each of these will translate. That being said, presumably, if that actually materializes, it could be good for commercial real estate in the U.S. if some of the money flows in that direction. So,
Thank you, Jim.
Marcia, I'll ask Clayton afterwards, and then Teresa, and maybe we'll finish it off with Marty, depending on the time. Marcia?
Thank you. Good morning. So, a couple of things. I just had the privilege of having dinner with a lot of our federal legislators, and we were talking about the soybean issue because, as you can imagine, downstate Illinois, that's a hot topic nationally. And from the billions to a couple of hundred thousand that have been ordered. I mean, it's negligible. So it's comical that we're calling that out as, they're ordering, that China is ordering. It's not enough to save our farmers. And I agree with you. Our farmers are going to have to pivot and plant something else if they intend to survive. I just had the privilege again to meet with several farmers and ranchers in South Dakota, and they are hurting, as you can imagine. This is impacting all of us on a wide margin. While I was at a current project, we had a group come in from Switzerland, and they're extremely upset because they said, this 40% tariff. They said, the reality is we export cheese, watches, and chocolate. And where do you think what is going to be the ripple effect, throughout the world? So I think that, I hope anyways, that there's some pause to this and there's some rethinking of how this is going to affect everybody, and if they're going to be able to actually invest in real estate, because so much more of their money is going to have to go to buying products that now have this much higher price tag, right? Do you think that's too naive of a thought process that I'm looking at? I am.
The Swiss did just reach, or on the verge of reaching an agreement with the U.S. to address that. So for people, I didn't mention Switzerland. They're sort of the outlier of all the countries I mentioned. They're getting hit with a 39% tariff. Mm-hmm. Really not clear to me why. I think it may be that they just didn't take the negotiations very seriously, at least 6 months ago. They also send a lot of pharmaceuticals, but pharmaceuticals are in that separate bucket I mentioned, so those haven't been hit. But yeah, watches, gold got some separate treatment, but chocolates, cheese. But they just, I think, have reached an agreement or on the verge of announcing what the agreement is. So I think they'll probably end up in a treatment that's much similar to the European Union. So anyway, we'll see. We'll know more in the next few days.
And at the end of the day, all of this is being challenged anyway, so it could be all for naught. This could be just a big distraction for us all. So I think getting back to the business of selling real estate. But Tim, I really enjoyed your presentation today, and I'm going to mute so the next person can step up. Thank you so much.
Thank you.
Thank you. We'll have Clade. Clade had a question in the chat. What are your thoughts about these tariffs leading to a broader trade war, and how might this uncertainty affect markets and consumers?
Well, I try to answer that. I think, it seems pretty clear the president doesn't want a recession, doesn't want markets to drop. And so, he loses leverage and political persuasion if that happens. So it might be that Liberation Day was sort of the apogee of the trade war possibilities, and the rest is negotiations and stabilizes a bit from here with sort of bumpiness along the road.
Thank you. Teresa, and then we'll finish it off with Marty. And then Clayton, would you mind muting yourself? We're having some background noise. Thank you.
Thank you again. So we all understand some of the pros. Well, hopefully many of us understand some of the pros and cons of tariffs. One pro being revenue, cons, the fallout, and who is hurt more by this. But I'm asking you to put on an economist hat and say, if you were the one who were implementing policy, and whether we call these taxes or not, and we said, all right, we need revenue, right? We have to do that somehow. How would you do it in tariffs in terms of taxing other countries, et cetera? What would that look like from your perspective? Because you have seen at a bird's level or a high level what's happening to everyone.
Well, I'm a lawyer, not an economist, so I get to dodge that question for that reason.
Oh, come on. You have some economists.
I will note this. There are tariff levels that are clearly manageable for the U.S. economy for certain products for certain countries. And in that sense, the president was proven right that any tariff. I don't approach these as a religious matter. Let's put it that way. and a lot of economists do approach it as a religious matter. When you combine the effect of the tax cuts too, tariffs can't offset the income tax, corporate or any personal income tax. But if you look at the combination of essentially the corporate and personal income taxes and a little bit higher of taxation essentially at the border, it does actually look like it's, I don't know if it was designed this way or because it was all separate parts. It does look like it's kind of offsetting. Certainly, what the administration hopes is that the immediate write-offs for capital expenses, for R&D on the tax code is going to have feedback effects of economic growth. And you guys are probably certainly seeing it in the data center space because that they're going crazy there. So anyway, I'll answer it partially.
Thanks.
Great. Well, Marty, we'll finish it off with you, and that'll be it.
Nobody will like my question, but do you really see anything good coming out of this administration?
Well,
Tariffs or in general.
Right.
Now remember,
right.
you have a code of ethics. As an attorney, you have a code of ethics to tell the truth.
Right.
I appreciate that question.
If you're negotiating, there's a little bit of puffery that's allowed under the bar rules.
Tariffs are a small little minor problem with this administration. It's a cluster of huge problems. So do you see anything coming out?
That's a very broad question. That's beyond.
I know it is.
That's beyond my expertise. I'll leave it there. Thanks.
I'll take a stab. Hopefully
do.
people wake up and start either running or follow someone to have them and get more energy at all levels.
Right. We need more education.
Awareness, because now we all have a lot more awareness, don't we?
Yes. Yeah.
Well, in that case, we'll end with all of the questions. So thank you for that. And I just want to say, Tim, thank you for an outstanding presentation and for sharing such thoughtful guidance on the global landscape we're all navigating. And your insights into trade, investment, and national security review help our global community understand the opportunities ahead. And with that, we're grateful for your time, your expertise, and your leadership. So thank you for this amazing presentation. I appreciate it.
Thank you. Really appreciate it, everybody. Great to meet you.
Thank you, Tim.
Thank you.
One of the guys there is I think it's past his bedtime. He's in Thailand.
I see that. Yeah. Yeah. Leighton, thank you for the kind words. Appreciate it very much.
And Bill Caton there, he is the godfather. He's the founder of this group. Hey, Bill?
Bill, you're muted, if anything. I don't know if you want to say anything, but
yes, yeah. That was, one of our top informative, current, pressing issues that we're all struggling with every day to try to understand, because the noise from each side counters each other and you don't know where things really stand. So the more kind of presentations like this we can have, the more people we're going to have on here. So Tim, thank you so much for giving us some transparency.
Great. Well, great to meet you all. Obviously, if you need any legal assistance on anything, we are a full service global law firm and delighted to help. Feel free to get in touch on any issues you may have.